Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Rennick, and we are at all-time highs. NVIDIA shares down a little bit, but the market's taking it in stride. Equity's in pretty good shape right now. The S&P 500 grinding 6504, clearing another big whole number hurdle, as it looks like bulls got at least what they wanted. When you've got the market firming up and VIX down after NVIDIA's report, that's a pretty good Thursday. Tomorrow we've got inflation. We'll preview that number, talking macro. I think compared to some of our shows so far to date, today's program is going to be a little bit more in the moment. Obviously, we've spent about half the show talking trading, volatility, and more every day in that first 20 minutes. But today we're going to be thinking about inflation numbers tomorrow. Dillian's going to join me to take a look at how some of the betting markets are preparing for inflation for the month of August. Brent Kochuba is at the top of the show. Really good analysis yesterday from his platform on expectations of volatility dipping as long as NVIDIA didn't bomb. And so we've got a pretty good look at some of the intraday action so far. We're going to go through a few other tools in there that give some really good perspective. Victor Werney joins us from CBOE, talking ETFs and the explosion of exchange-traded products. That's going to be a great conversation. Show 5 and the first CBOE guest joining us, so that's kind of a special moment here on Chicago Future of Finance. Jason Barsema will be with us to talk product as we look at Halo Investing's growth, another story of someone I've known since the time I've been here in Chicago, whose product and company has grown like a weed. It'll also add on to the conversation we had earlier in the week with Jeff Chang at Vest about buffered funds. There's a lot of products vying for the same market of defined outcomes, and Halo's growth here in Chicago has been a big factor in that category. Then I've got some really fun guests on joining us to talk stocks and trading around some of the big events. Nigam Arora, one of the original newsletter writers, joins me. He's a nuclear physicist, and every time he's on one of my shows, he tells me something I haven't heard before. He's always got some kind of a hot angle. We're going to be talking NVIDIA, his take on the semiconductor trade, as well as some of the other juicy tech and growth stocks. And Scott Bauer is going to help me navigate my master trade because it's doing okay. MicroStrategy is down 1.2%, but I got kind of stuck in a weird spot with a long put calendar that's getting eaten away at a little because part of my trade that's short, we're blowing through that strike as master's fallen even faster than I thought. So we got a busy show ahead. Let's go into the intraday action. Let's look at the S&P. Let's go to Brent Kochuba, and we're going to go into SpotGamma as well. Brent joining us for a look at all-time highs in the equity market. Brent, this is the definition of a steady bullish grind. I mean, you really got to squint to see the slope on today's chart, but it's up and to the right, and it's good enough to get us through 65.
Yeah, we've been talking about the idea of the zombie, and the zombie was a market where vol just contracts and the market just kind of grinds mindlessly higher, and that would have to be unlocked by NVIDIA just not bombing, and that's kind of what my takeaway was.
It's a friendly zombie.
Yeah.
It's not eating your brains.
That's right. And, so they put up giant numbers. No one could tell me if they were better or worse than expected. And so what's the end result of that? Well, the VIX is now down substantially. We have Labor Day weekend coming up here, so people just are more incentivized to pound that vol. We were looking at the platform before. We're seeing a 6% implied vol for Tuesday, and we're on Thursday. We're not even on Friday yet. So, tomorrow is going to be even, I think, more incentivized to kind of just crush that vol. This invokes
inflation goes smooth, right? That's kind of the last thing we got to get through.
Yeah, there's that data tomorrow, but I think what we've seen time and again here is like we need to be hit over the head with like a multi-standard deviation, hot inflation print, NVIDIA miss, something to make people believe in downside, because right now everybody's incentivized just to chase, and you see that out of every move, right? And so yes, there was jobs data and GDP data today. What did that even mean? It meant kind of nothing. So we're really in this situation where we need to catch something really nasty in order to force people's downside hand. And at the moment, what you have is just these derivative flows that are locking price in, and you got to kind of do something, or you have to have some kind of big enough data to break those binds, right? You can see in your chart there, we're pulling into that 6,500 level. There's a giant iron condor wing right there. That's the big blue strike. You see it. That's a
6505.
That's right. So that's the magnet for the day for today.
And we're there right now. So if we get through there, do we get to run?
No, well, for today, we're just pinning this thing down, right? And that's
Okay.
today's objective. I think tomorrow we wrestle in more or less the same area, and then next week we're just gonna crush vol. Like no one's really gonna want to own puts, right, or believe in sharp downside into a 3-day weekend. So again, you really got to have some kind of just unbelievably nasty print tomorrow to make people change their minds on this stuff, because nothing feels better than kind of sitting at the beach in the Hamptons or whatever, full on
Hmm.
short ball that's guaranteed money, right?
I got two pictures, text today from people in various places of leisure, in the mountains, on the beach. Okay, so by the way, for those that have been following along, QR code in the middle to get a discount and on a freebie, right, for your guys' flow
Right.
report, which is really good. There's a few other functions in here today that I want to get into, Brent, that so far we haven't really talked about too much. One of them is over on Trace, right? We were going to look at how some of this the grind has been happening. So that's kind of
Yeah.
what we're looking at right there. The gamma walls you mentioned, we kind of got pinned a little bit, but if we break free, that could be really, really nice.
Yeah,
Um,
and that's a zero DT position. So two things about that. Number one is that
mm,
is a zero DT position, but we also have the
mm,
JP Morgan collar trade, which everyone talks about. That's an end of September position at 65.05. So if we get above that, there's some sort of implied support, particularly as we get into September. So if we kind of clear that level, then everyone can kind of use that as their risk off level going forward, right? It's kind of like, okay, there's a big position in the market. It sort of stabilizes things in through September. So I think as long as we're now above 64.50, then we should remain stable. If the market starts to creep up a little more and we get into 65.50 ish, then we can really lean on 6,500 as being this big level of support due to positioning, right? And
okay.
that's going to be the big level.
Um, if we break through, then maybe we have a different conversation. Look, if inflation goes nice tomorrow, we break through that big wall, that zero DTE at 65, then boy, it could be that kind of next stage of a late summer move that people are looking for. One of
Yeah.
the things that you were also pointing out to me, I just went over to the scanners page on your platform, and we've got a few of the kind of main benchmarks I like to watch. NVIDIA's on here. You got home builders. We got the Qs in here as well. This is showing us where things rank in terms of IV. Take me through this, Brent, because I think there's a couple interesting things to glean from here.
Yeah, if you see dots along the bottom, those are low implied volatility options, right? So people are not expecting much movement there. And you can see across the board, for the most part, that's where most of these ETFs are in particular, like IBIT, which is Bitcoin, the Qs, MicroStrategy, Spire. That stuff is all clustered not only in the bottom, which infers that people don't have high volatility expectations, but the other interesting thing here is they're all clustered on the left of this chart. What that means is that puts on a relative basis are a little bit rich relative to calls. So
Okay.
if we do unlock this kind of grind and this sort of zombie thing for the next couple of weeks, then I would expect to see people start to pick up the bid for calls, which could accelerate upside, maybe more in something like the Qs or home building or certain stocks. So I've been calling them memes and themes. And we would expect to see some of these options prices shift to the right, which means calls are getting a bit rich. As an
Mm,
example of rich calls, look at gold. Gold has been doing really well. I know
I
we've been
see.
talking about that a lot.
So gold on the other end, which has generally been a really solid chart, but it's interesting that the call interest is stronger in gold than it has been on stocks, despite stocks being pretty firm too.
Yeah, that's exactly right. And I think there's a lot of political uncertainty or whatever uncertainty there is in the world draws that gold bid is the narrative around that. And so what this chart is telling me is like, hey, calls are pretty rich relative to puts. So maybe I'll buy some call spreads if I was interested in going into gold, but we're not at the overbought signal. The overbought signal tends to come or the extreme move signal tends to come when we slide north on this chart, when we move up the y axis. So if you look at Ethereum, for example, that's the Ethereum ETF there,
Mm-hmm. Okay.
ETHA. That really had incredibly high implied vol going
Because
back
it was
about
just
8
going
months
crazy
now.
Ethereum, I guess, right? So vol was
That's
just
exactly right.
pumped
And
up.
and yeah, and so when you see that implied vol rank move up to extreme levels, that's usually a sign the move is done. Now the move could be to the upside, the move can be an extreme downside move, but that's the options market screaming to you that hey, move is probably stretched a little too far. So the
Mm,
takeaway from this is that even though we're at all-time highs right now in the major indices, people aren't piled into calls at the moment.
mm.
And we may have just triggered with this all's quiet on the Western front in NVIDIA here. We may have triggered a little bit of call buying. I think that will come in, and that could drive single stocks, means, and themes a little bit more than say the S&P.
That's a really interesting perspective. So to basically recap it real quick, because I think this is a big part of the message from this week, especially given it's been stock specific and that tomorrow we get more macro with inflation, is that even though equities have been fine, you haven't seen a lot of aggressive call buying to the upside. You've seen it more in gold. But if things go smoothly as they are today and then tomorrow too, suddenly maybe this starts to flip around and you get maybe a more juicy type of momentum move to the upside, which also makes it sound like if I want to be bulled up, it's still, I mean, look, VIX is down today. It's pretty cheap to buy upside call exposure. But the idea is if you want to do it in gold or something's already been up there, then maybe you want to hedge it out with something as a spread.
Yeah, and the thing about this is like you're seeing the options prices in the scanner here on the bottom left. What is that telling you? Calls are cheap. So maybe you don't want to believe in this narrative of the market's going to grind up here, but the way to play it is very cheap. You can get calls,
Mm-hmm.
call spreads that don't cost much for September options expiration. Then if we do get some of this right taily moves in some of this popular stuff like small caps and IWMs, then your risk is defined, right? It's cheap risk and it's defined risk, and so it's a great way to play it. I know we just also wanted to check implied vols real quick. So if you go to the volatility tool, which is the second tab down,
Okay.
one
Volatility
more down, there we
dashboard.
go. And check
Okay.
out the term structure here. I just want to show you
Term
what people's
structure. Okay.
expectations of risk are.
Oh, nice. Okay. So this shows us what yesterday's term versus today, yesterday in
Exactly.
white.
So that teal line is current implied vol. So next week, because we have this 3-day weekend, we're pricing in like a 6% implied vol. You got a month out, we're at a 9% implied vol. We're at about as low as you can get, right? And even though there's
Mm,
PCE and some of this other stuff, that's next week's problem. We're not even on Friday yet. Tomorrow, they're going to sink this vol even more. So a lot of
mm,
people are saying, hey, that NVIDIA thing didn't matter. It's a non-event. Well, look at vol's reaction here, right? The gray line is term structure. Yesterday's at the money implied vol. NVIDIA comes out, it's a nothing done. Stocks just kind of grinding along, and vol just got smashed. And if vol
mm.
gets smashed, that's going to put a bid into the equity market. And I think vol's just going to continue to bleed out here. Again, barring a standard multi-standard deviation print next week, then we should expect vol just to continue to drift. And that leads us to the big event, right? This is more of a time frame to be bullish as opposed to price. The time
Okay.
frame is September 17th. You got FOMC the same day as VIX expiration. Then you got a huge equity expiration 2 days after. So we really have about 2 weeks now to sort of cruise with existing positioning, dominating that vol suppression, which helps just keep a bid into the market.
Nice. All right. So vol starts to pick up a little bit pricing uh, after the Fed. So
That's right.
people still thinking about that, but I don't know. Looks like we got through NVIDIA smooth. We could sail from here. Great stuff this week, Brent. Appreciate it, sir.
Thanks so much. Enjoy your weekend.
You got it. All right, coming up, let's talk about defined outcomes. Jason Barsema joins us from Halo Investing, a guy who started coming on my show something like 7.5, 8 years ago. I knew he was smart as a whip when I met him, but I didn't know how much this market was going to grow. And he was one of the real early pioneers that built this defined outcome market. We'll be right back. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. CBOE is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from CBOE, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Chicago Future of Finance. I'm joined by Jason Barsema, co-founder at Halo Investing, known, I think, predominantly as a structured product business, but getting into more and more, and an incredible amount of growth since we met each other almost 8 years ago, Jason.
Yeah, thank you. I think when we first met, we were doing about 200 million or so in volumes, and this year we're now pushing 40 billion. So It's been a pretty good ride since the first time I was on your show.
Yeah, you're a perfect example of somebody that I met when I first came to Chicago, and I just knew off the bat, all right, this guy's a really smart dude, knows the market really well. But since then, as we were talking about markets, the company obviously has gone through that exponential growth, and I feel that you were really early on the notion of defined outcome products, if you will, for the advisor base, which is now a huge market. We have Jeff Chang on from Vest with buffered funds.
Yep.
You got people with equity income style stuff.
My friend Bob Oros was
from Hightower. So what was it early on that you knew this was going to be something people wanted, needed, et cetera?
Well, I think it was all through experience from my private banking practice at Credit Suisse. And I always thought about wealth management very simplistically. It was really about preserving your wealth. It was about growing your wealth and about generating a level of income. If you can do those 3 things within your portfolio, you're pretty much set. But financial advisors tend to complicate things by having all this sophisticated analysis and asset allocations of 100 different asset classes. And for me, the everyday investor just wants to be able to grow your wealth, preserve your wealth, and generate a level of income. When I was at Credit Suisse, there was a product that I was using called the structured note that represents today still about 25% of my own portfolio.
Okay.
And at the time, there were 20% of my portfolios, and they did just that. They helped you protect against market declines, helped you participate in the upside of the market, and generate a nice level of income within your portfolios. The problem was that you needed $1 million to buy one product. So most of us couldn't afford to buy a structured note. So what we did was we created technology to automate the manufacturing process and digitize the distribution. So to make a long story short, you can now buy a structured product for $1,000 on my platform. And
I see.
The rest
was the big
history.
tech element, was bring down the costs of that in a big way.
That was the tech side. And as I always like to tell other entrepreneurs, you could have really good tech, but a nice house in a lousy neighborhood is still a lousy house, right?
Fair
so
enough.
You need to have a nice neighborhood. And for us, we always saw where the trends were going within wealth management, which is people want defined outcome investing. At the end of the day, we just want to make anywhere from 7 to 9% on our portfolios.
Okay.
Right? We want protective investing, right? Which obviously structured notes give you that downside investment of protection. And we want personalized investing. Even if you and I have the same net worth, you and I are different, right? And so we want investment solutions to be tailored to our specific goals, and not just return goals, but liquidity goals, time horizon goals, risk goals. And so all of those really make up the genesis of what a structured note is and other protective investing products. So we started with structured products because it was a market that's never been really disrupted, and now we've expanded into a lot of others.
I want to hear about that. I want to bring in the AI. I asked our AI that we're using for some feedback on this, and I think you just kind of hinted at something. And that is that structured products are ultimately kind of a bespoke thing to some extent. Let's look at the Q&A there, which is that you've got competition. You've got buffered ETFs we talked about. got some of the hedged equity products. So I asked basically kind of when does it make sense to use a structured product? The AI says structured notes. Now I use the word only, so I'm sure you'll push back on that. But structured notes only make sense when you truly need custom design payoffs, like hedging a concentrated stock position or creating a very specific maturity profile. Buffer ETFs give you much of the same downside protection, but with daily liquidity and transparency. Hedged equity funds are different. They depend on a manager's timing skill. What do you think? What would you push back on that response, or where does it get it right?
Well, first and foremost, this is a problem with AI because you would never use a structured note to hedge a concentrated stock position. You would actually be adding to that exposure. What is a structured note? It's a combination of a zero coupon bond and a derivative. So if Oliver held NVIDIA, unless you would like to sell some of that NVIDIA and then ultimately buy a structured note to protect it, you wouldn't be buying a structured note and hold NVIDIA because you'd be doubling your exposure to NVIDIA.
So it's a replacement?
Yeah, so some people say, hey, look, I'm fine and comfortable holding NVIDIA, but I'm going to sell some of that and buy a structured note to have some protection. But many people who have concentrated stock positions aren't utilizing structured notes. They're using tools like variable prepaid forwards that we just launched on our platform as well.
Okay.
In regards to...
And how does that work? Variable prepaid forward. Tell me about that.
At the end of the day, it's a stock collar that allows you to unlock liquidity. So it's a really, really elegant solution for someone who does have a concentrated stock position. For example, if you've got $1 million worth of NVIDIA stock today, you probably don't want to sell it because perhaps you're still bullish on NVIDIA or you don't want to take the tax consequences, right? You're going to be paying long-term capital gains.
Big thing people are trying to figure out right now.
Yeah, and if your position's worth $1 million, you probably don't have a lot of other assets for many people because it's thus concentrated within your portfolio. So a variable prepaid forward allows you to protect your NVIDIA position, meaning it prevents a certain amount of decline from your NVIDIA position. So it stops you out at a certain amount of loss, allows you to still participate in the upside like a structured note. But what's cool about it is that you can unlock liquidity. You can actually borrow off that position. So you could still hold liquidity, actually borrow off that position to buy a house, send your kids to college, buy a boat, whatever you want to do with it. It's an institutional grade solution that we have now made available to the masses beyond just someone who's got $100 million position.
Another piece of overlap, kind of with Bob yesterday, was talking about one of his other ventures that he's on the board of is securitized lending. And it seems like there is a big need right now.
We just launched that as well.
Okay, so it seems like there's so much in the advisor world right now. There is a need to unlock liquidity after what? Big gains that people have had without paying a bunch of taxes?
Why do you invest in anything, right? Is that you invest in anything because you ultimately assess what type of liquidity that you need. The amount of money that you have in hedge funds and private equity, in part, is a function of do you need liquidity on those assets, right? And so people ultimately put premiums on liquidity. With what solutions that we bring ultimately to the advisor community, both RIAs, independent broker dealers, private banks, is that we want to give you solutions to be able to protect your assets, right? Because once you're wealthy, you never want to go back, and volatility makes everyone sick, lack thereof in this particular market. But more importantly is we want to bring you institutional grade solutions that provide you the type of protection, the type of liquidity that you need.
Okay.
Variable prepaid forwards. Structured notes aren't for everybody. So variable prepaid forwards are a great way to hedge concentrated stock position. When you look at securities-based lending on those structured notes, you may want to borrow off of those structured notes, which if you don't work at a wirehouse, you cannot do. That does not exist. So we just launched those solutions to be able to borrow off your structured products and also your bonds, also your equities. And in some cases, in many cases actually, hedge funds, private equity, and art, you can now do through our platform as well.
Wow, very interesting.
Yeah, and so we want to be able to meet the advisor where they're at. And the issue is that if you work at a Morgan Stanley and a JP Morgan, you're blessed to have all of these services. Once you become independent, they don't really exist. So now with Halo, they do.
Okay. Just real quick, are you, with all this growth into different but related kind of solutions, does AI make it smoother? Does it make it easier? Because from a tech background, are you finding ways to plug in AI into this business model?
Well, now after reading the response, I'm a little nervous utilizing AI. But all jokes aside, AI is really important, right? It helps us make better decisions. Now, we still have to be able to use our own analysis in making those decisions, but it helps us make better decisions. We recently launched a portfolio modeling tool called Arora, which has really been amazing. It's the first of its kind, allows you to analyze the impact of structured products within your portfolio for the first time. So normally you could analyze stocks and bonds and even some hedge funds and alternatives, but never structured products. And my whole thing is, well, how do I know if I want to use that structured product if I don't know how it impacts the entire portfolio?
Okay.
So we launched Aura. Our next version.
See how it all connects into the.
Yeah, exactly. Yeah. So when you want to buy a growth structured note, how does that change your Sharpe ratio, your Sortino ratio, your liquidity profile, your income profile? So now with AI, we're taking that to the next level at the end of this year, where Oliver's ultimately going to be able to model out exactly what he wants to do. Do you want to be able to preserve downside protection? Do you want to focus more on defined outcomes? Do you want to generate more yield within your portfolio? All of the above. So our systems are getting smarter and smarter and smarter, recommending the right trade at the right time at the right place.
Jason Barsema, great to catch up with you. Love the context, and the more I've learned about the advisor side, the more I'm interested in the stuff that you're talking about. So let's be in touch.
I appreciate it, Oliver. Thanks for having me.
Very good. Jason Barsema, Halo Investing, based here in Chicago, one of the big engines of growth. From that subject, we'll kind of go to some degree the other end of the spectrum, maybe fully. It's time for the gamble. Mr. Jared Dillian joins us from the Daily Dirtnap, the author. Jared, you've seen a lot of Wall Street product in your day. Give me a quick thought on structured notes and what you heard there.
Oh man, I mean, I worked on a derivatives desk at Lehman, but I was like the dumb Delta One guy. I wasn't involved in structured notes at all. Like the rocket scientists that did that stuff sat behind me. I got scabs on my knuckles. I never did this structured notes.
I love that. I haven't heard that phrase. All right, well then, perfect for this block. Let's switch it up. Let's talk about simple binary things for tomorrow. Inflation, hot or not? And as we talk, I'm going to go through some of the bets on Kalshi, which on the macro side, it looks like right now they're basically saying that it's unlikely to be above 2.9% for August. But that's for CPI. We got PCE tomorrow. Take me through your thought process.
Yeah, I mean, thinking back to the PPI print we got a couple of weeks ago, which was outrageously hot, in which people kind of discounted at the time. I think the risk is to the upside for tomorrow. 2.9 is not really a scary number, but 3% is. 3% could really shake things up going into Labor Day. You could get a significant sell-off in stocks, bonds, precious metals. You could get a big rally in the dollar. Things are, look, this has been a super quiet week. I'm getting a ton of out-of-office replies on my newsletter. Everybody is gone.
That's what I was saying. I'm getting pics from beaches, rivers, mountains.
So there is the potential for an exciting day tomorrow. Not saying that that's definitely going to happen, but, given where PPI came in, I think there's that possibility.
To that point, does kind of echo what we were talking about with Brent at the top of the show, which is the market priced for fairly low volatility outcomes. The market too making highs. I just feel like there's no lack of spending power. So, why should inflation drift too low?
Yeah, I mean, I saw what you were talking about at the top of the show. It's tough to be short. I mean, there is, like 5 to 8 billion worth of new money coming into the markets every day. I saw the charts of the 65.05 strike price on that condor and how it's acting like a magnet and how we're going up there. Like this is a tough trading environment, and I tend to lean a little bit bearish at the moment, but it's kind of hard to argue with the facts.
Do you see the potential for sticky inflation to become upsetting for those who think the Fed's going to go on a cutting spree? Take me through the connections into the dovish Powell narrative, the way you see it right now.
Yeah, I mean, I think we're going to be cutting unless we get just an outrageously hot inflation number. I think 2.9, even 3, is not going to stop the rate cuts. Right now we're pricing in a little bit less than an 80% chance of a rate cut in September. I think if we got a hot inflation number now, that would probably go down to about 60%. But just in terms of the internal dynamics at the Fed, the two dissents with the governors last month, it's, there's institutional momentum to ease monetary policy, even with unemployment rate at 4.2%, even with stocks at all-time highs. I think we're going to get a handful of rate cuts this year.
Looking, if we come back in here to Kalshi, what's interesting is there's always this kind of spread between betting markets and, say, CME futures. To your point, CME futures are at like 80 plus percent, whereas Kalshi says cuts at 76. Obviously, you've got a much more liquid market from the futures, but anything to be said about that spread? Do you think that there's maybe a little bit of, I don't know, is there an ARB in 10 percentage points of what's going to happen in September?
I don't know that there's an ARB. I think you're looking at two different constituencies there. If you're looking at, Fed funds and SOFR versus Kalshi, Kalshi is definitely, more retail. It's more punters. It would make sense to me that they're a little bit more skeptical of a rate cut. I suppose if you wanted to buy Kalshi and sell Fed funds, you could do that. I think it'd probably be more trouble than it's worth.
Right. Well, it's interesting, too, because the point of the punters is I would kind of think that they would be more jacked up about the cuts, but it's only at 76 here, actually down a point today. But what's interesting, too, is kind of thinking about afterwards is, do we do one and then done, see how things go? The other thing, too, is do you think that markets making all-time highs, does that relieve any of the pressure from Powell?
Well, I think the clues for that are in Powell's Jackson Hole speech. And, I read the speech, and it was a very nuanced speech. It wasn't an unequivocally dovish speech. A lot of people said that the market overreacted to that speech. I think the reaction was actually appropriate. It was the first time that he actually really opened the door to rate cuts at all. So I think the reaction in stocks and the dollar and everything, I think that was actually appropriate. When we talked last week, when the Kalshi numbers were trading at 81 cents, you said they were selling dollars for 81 cents.
Right. Yeah.
And I still think that's kind of the case.
Yeah. Jared, great to catch up. Appreciate your take. Nice macro for us.
Thank you.
Inflation tomorrow. Thank you, sir. Jared Dillian, author of the Daily Dirtnap. Let's talk some ETFs. We got a massive trend that's been going on now for years, and under the watch of Victor Werney here at CBOE. How many ETP launches have you overseen, Victor?
Yeah, Oliver. So personally, almost 1,000 at this point. It's
Wow.
been really exciting. I joined the organization back in 2018, where we had roughly 300 ETFs, and we just crossed 1,000 here in the United States just last month.
Amazing. Great to see you. Good to have you here.
Thank you for having
You're
me.
based in New York, but you're here in Chicago a lot.
Absolutely.
What is hot right now that you see? Is it the options-driven stuff in the ETFs that people are getting most excited about? Because that's kind of what I've been getting excited about. Income-driven strategies, people taking all these wild stocks and taking their volatility and generating income out of it seems like a really popular thing.
Absolutely. So as an ETF industry, we're on pace for over 1,000 ETF launches this year alone.
Wow.
And with that, we're seeing 85% of the ETFs come to market be actively managed strategies with 40% derivative-based products. So they're either incorporating options, swaps, futures, whatever it may be. So it's been really exciting to see the increased derivative adoption within the ETF wrapper.
When you were launching 1,000 a year, and I don't know what the IPO count is. I'm pretty sure it's not 1,000. I don't know. I have to check. But if the ETF launch count is moving faster than like the new company count, eventually is like the tail of the dog going to come around in some weird way? Like, how does that work?
It's really interesting. So for every 5 or 6 ETF launches, we're starting to see one ETF closure. So launches are far more outpacing closures. But to your point on the single stock side, we're seeing many ETF asset managers come to market with leverage and inverse strategies, covered call strategies on single stocks. And many of those product strategies are gaining quite a bit of momentum in the ETF space.
So 1,000 a year, roughly, kind of an annual pace right now. One closure for every 5. So, all right. So then we're looking at basically maybe 200 get closed down at that pace. That's a pretty good explosive pace. But from what I understand in the ETF world, it's hard to make it really sustainable if you don't get if you don't get flows pretty quickly. I mean, you can put up your own money, but is one of the results then that ETF shops are going to be demanding higher standards for funds, or what is the implication?
It's really interesting with all these strategies coming to market. Historically, you'll see many core equity, core fixed income ETFs launch. But now asset managers are really looking to diversify their product offerings. And with that, giving them a little bit more of a timeline to catch in the industry. So with that, to your point, we're seeing a lot more derivative-based strategies, people utilizing options in different means. Defined outcome ETFs are a great theme.
Right.
There's now over 400 defined outcome ETFs out there today with a total AUM of 70 billion.
Wow.
So that's a space on the CBOE side we're really on top of with our Flex Options team, our Data Vantage team.
Yeah.
It is a great story for the industry.
Flex Options, Jeff Chang earlier this week at Vest uses a lot of those, I know, for the buffer funds. We just talked with Jason Barsema about the structured products competition. The defined outcome space is ripping right now. What's the argument for the ETFs versus some of the other, approaches to accomplishing that same goal?
I think with the ETF, there's a lot of transparency. You can look in the underlying holdings. You can trade it like a common stock. It's very easily accessible in your brokerage account. Historically, many people would need to access these strategies in a structured note wrapper, whereas the defined outcome ETF is really democratizing that for the average everyday investor.
That's kind of where, when you think about what's the dream in finance today, if you've got a great idea. Now, for the part of the trailer in this is, if you think you've got the edge, Chicago's the place to make it happen. And in the back of this could be, you're a prop trader, you're if you want to be a hedge fund manager one day, okay. ETF, is that kind of a path for people to execute a vision, or do you see mostly established big players throwing their weight around? They can say, okay, I can put up 300,000, the year one or whatever it costs on average. Is that the case, or do you see it as a place for startups, for newcomers?
It's a combination of both. We're seeing some of the largest asset managers start to get into the ETF space that have been traditionally involved in the mutual fund strategy world, whereas we're also seeing many firms enter the ETF via a lot of these white label service providers that allow them to do SMA to ETF conversions or mutual fund to ETF conversions.
Okay. So, all right. So then you've got a lot of that kind of old money kind of switching over, which makes sense. Is that then the inevitable kind of end of the mutual fund? Obviously, there's some that stick around, but I imagine the standard, if you're a mutual fund, the standard is going higher every year to keep running as a mutual fund.
I think it's an exciting time to be in the ETF industry, especially with multi-share class coming up, which is essentially the tack on of an ETF to a mutual fund product.
What's the next big thing we should be looking for?
Multi-share class ETFs, but also crypto.
Crypto, right?
Crypto's very exciting in the ETF space.
We've got options on crypto stuff that's happening right now too, which I know some of those are listed here as well. Is the idea to not so much get exposure to the underlying, but kind of wrap it in such a way that's more amenable to a different target audience?
Yeah, so here at CBOE, we filed for the first spot Bitcoin ETF in the United States. We list the majority of spot Bitcoin and Ethereum products. And with that, it's really exciting in the options world to be able to now utilize option strategies on some of these spot Bitcoin products. Mm-hmm. CBOE actually launched an index, CBTX and MBTX, which is essentially an index comprised of various spot Bitcoin ETFs that allows you to trade options on that index. Okay. So holistically across the organization, we're constantly looking at innovating in a number of different areas that touch the ETF industry.
As the ETF launches and the targets and the goals of them get a little bit more complicated, and a lot of these are very actively managed, are fees becoming less of an issue? Because it kind of used to be, I feel like, when you came from the passive index ETF being the baseline, it was like, how low is your fee? That's what matters the most, and kind of nothing else. And that's what really disrupted the mutual fund world. But does that matter less now that they're addressing more complicated solutions?
Oliver, I'd echo your sentiment there. When I first joined the industry, it felt like from an expense ratio side, there was a race to a little bit to zero. But I'd say with the rise of actively managed strategies, I don't think expense ratio is as much of a conversation point as it was historically.
Okay. But I guess to be competitive, is there still a range? Like even if you have an active fund, where do you, as an ETF, where do you sense that you're not competitive if you hit a certain rate? Like what number is that? What is it, above 1%?
It really depends on the strategy. There's so many different unique strategies out there today that are in different areas of the universe that have their expense ratios layered accordingly.
Let's say you've got the most brilliant fund. What can I charge for? Can I tell people, hey, I'm doing 1.2%, I'm doing 1.5, or do they start to go like, all right, what's the why does it cost so much?
There are ETFs with expense ratios like that out there today that do have hundreds of millions in AUM.
Yeah, and they're cranking because they must be doing something very well. The performance, I guess, becomes key, becomes pivotal.
Absolutely.
Love it, Victor. Great stuff.
Thanks so much, Oliver.
Yeah, 1,000 in the last year, getting close, and CBOE obviously a big entry point for a lot of folks in the market through the exchange traded products. Victor Werney of CBOE. Episode 5 of this is episode 6, so we got through 5 episodes of Chicago Future of Finance without an actual CBOE guest. So Victor, you're the first CBOE guest.
Fantastic.
At the CBOE, great stuff. Everybody loves ETFs. Let's go into my platform here for a sec. I want to check out some of the stuff we talked about earlier here. I'm going to pull up a few things that we looked at in Kalshi because I'm watching the market try and firm up. And the fact that we've got rate cuts expected coming on the way. The market's kind of hanging in. We're still at 65-ish or so. Not bad. We're going to take a look at some of the tech trade. We're going to check in with Mr. Scott Bauer as well, who's going to help me out with some of the MicroStrategy stuff I've been working on. But we'll keep it posted as markets look pretty solid and VIX continues to slide a bit here. Taking a quick little break, get situated, and come right back. Welcome back. Let's go into the market and keep an eye on the S&P 500, which is pushing right now. Got SPY at 650. The grind today is very real as we are looking at all-time highs. Volatility continues to subside, and I'm looking at Trader Oasis here to get some of the intraday look at a few of the big items I'm watching right now. Number one, S&P continuing to push. This is pretty impressive stuff. I think in particular, if you zoom out, just looking at the last 90 days, this is a chart that just goes up and to the right. I mean, it's an absolutely beautiful trend here. How can you not love it? The fact that we continue to make higher lows, higher highs, just a real smooth grind. Just like we talked about with Brent Kochuba over the last 2 days, the fact that we didn't need much, just not a blow up, and it worked. NVIDIA continuing to be a force for the market, even when it's down. The fact that it wasn't a major hit and the fact that all the moves stayed within the expected ranges. The chart for NVIDIA with a big candle, right, stuck in the middle at 180 right now in the range from the last 3 weeks. I think that's a perfectly fine outcome. And by the way, it's coming back. Maybe it closes positive on the day. So NVIDIA looking pretty decent, just below 181 now. That is a good improvement and a pretty good outcome considering this is still the horse for the AI trade. We looked at SMH as being a stronger chart, but one with potential for head and shoulders if you saw today break down and go the other way, but instead we're firming up. Here's the head, here's the left shoulder, and this one looks like it's stretching instead of breaking down. So I think that's a very good sign. The fact that you've got SMH now at $300, pushing pretty close to the recent highs, that's pretty great stuff. The fact that also you've got a few of the big juicy trades on the downside, like MicroStrategy, and the market's okay with it, that's pretty important too. Master down 1% and a continuing weakness, but the market doesn't mind. Look at Bitcoin and the IBIT. Also, just sitting here at 64. Bitcoin, not a lot of life in it over the last week, and that's okay too. I got Scott Bauer who's going to join me as we look at the intraday session here. You know, Scott, the fact that NVIDIA is trying to plug higher reminds me why my risk radar is still green on stocks, because it looks like this thing is just a horse. Even when it doesn't rally, the market is happy that it just didn't break down.
That's exactly right. That was probably the worst case for the market, is that the expectations were too high. They didn't meet them, and we saw a big breakdown. And we didn't see that. Even if we had traded down and stabilized around the lows after session last night, 172, that also wouldn't have been so bad. That, the expectations were so high, and this stock has been on such a run. But the fact that we're, hovering near the flat line-ish or so, that is really bullish for the overall market, because something we talked about yesterday, Oliver, and all the S&P 500 stocks, there's 35% of them that are tied somehow to the AI trade. So with NVIDIA, reconfirming guidance and the numbers actually looking really solid here, that sets up, that this AI trade should continue.
Yeah. SMH better looking than NVIDIA generally. So that holding on, I think, is, the bedrock effectively of the tech trade. That, is now at this point as reliable as ever. It kind of had that look like potentially it could go ahead and shoulders, but it didn't. So there's really not much to complain about here. VIX down 2. Hopefully tomorrow doesn't give some hot print, but taking you heard from Jared Dillian earlier, there's not a lot of whole reason to worry about a super hot print at this point. What do you think?
Well, I agree with that, but that could also be the the thing that really affects the market. All signs point to inflation, stabilizing. I'm not going to say coming down, but stabilizing a bit. So I would say the odds of a hot print are not real high. But listen, with volatility just absolutely, and I'm going to use the word plummeting. It really is. And yes, we're going into a long holiday weekend, but with vol down here, if I had long positions in the marketplace, even going into this long weekend, you bet I would be hedging it somewhat with either some upside VIX calls, some downside puts in the Qs or the S&Ps, just too cheap not to lock in or take some of that protection right now.
Yeah, that's important. I'm going to pull up my risk radar just kind of show what I've been thinking lately, which is strength in stocks, strength in gold as well, which has been on the outer rim of green.
Yep.
The dollar, which I kind of shifted potentially more to the green side. Maybe I need to rethink that because the dollar hit today. But bonds have been solid yellow. And with inflation tomorrow, I thought maybe we talk about dollar and bonds for a sec because, Scott, for the most part, these have been right in the middle of the range for me.
Sure have.
Representing essentially range bound. And I haven't really been able to discern any direction so far in either of these. Tell me what you're thinking for those.
We are still in the middle, and it's tough to really think about direction given still all of the question marks about rates. You know, with 25 bips reduction that is priced into the market right now, that's priced into what we're seeing in bonds and the dollar. So with PCE tomorrow, jobs number next week, those are the two big data points that could really move the needle on either one of those. But looking at the charts, like you said, we're right in the middle here. Intuitively, I would say rates are probably going to come down a little bit further because I don't expect a real hot print tomorrow. What happens next week with the jobs report, you know, we'll have to reevaluate till then.
Yeah. Jobs, I think, could be interesting for bonds. Overall, though, you know, it just looks like a market that continues to have give and take. And I can see that because if you ask anybody, they're going to give you, you know, there's like a 50% chance. I mean, I think it's starting to skew to people generally being more dovish in their interpretation of what Powell said after Jackson Hole. But even a lot of people who are dovish will say, oh, he doesn't really need to. He's being pressured to. So that kind of lack of conviction, I feel like, is, by the way, the sweet spot for bonds as far as risk assets are concerned. I think dollar yellow, bonds yellow, range bound for both. It's kind of what you want to root for if you're long risk assets.
Oh, that's a great scenario. Absolutely. And then, you know, throw in what we saw out of NVIDIA. And boy, oh boy, that threesome right there. You're right. I mean, there's no reason, you know, to believe that the market is going to have any sort of significant pullback right now.
Yeah. All right. One thing that's had a pullback, Mr. Bauer, this is where the Trading Academy part comes in.
Yes.
I need a little help, all right? Because everybody knows I've been short master. I had it paired with a long Bitcoin trade, but I started to pull back some of the long Bitcoin side because master was looking so weak. And so I've been in this trade. I've been in a pretty good position on this trade, but I actually did it via a long put calendar where I was short the shorter term puts because I didn't think master was going to break down quite as fast as it did. So I'm still making money on days where master is down, but my strike at 350 that I was short already went through. So it's like I'm barely like squeezing out gains now. I'm trying to figure out what I should do with this position. What do you think?
So that 350 put that you're short for next week still has a lot of premium. It's still got about $5 of premium in it. So it really depends on your outlook, Oliver. When you got into this position, this trade, that was awesome because you were buying time, the September, December, and you were buying that time where master volatility was so incredibly cheap. Now, let me say something here, and I know you want to keep this short position on. When I took a little deeper look into master, the 50% retracement, 340, from the lows that we saw back in April, right around 235-ish, up to the highs that we just saw, 456, 457. That 50% retracement area right there around 340, that could be a pivot back to the upside a little bit. Not a pivot meaning we're going back to all-time highs, but you would look at that as a significant area where you might see buyers here. So if you are still, if you still have the notion that you want to remain short, if it was me, I would look at those two puts that you have, one expiring next week, one expiring on the 12th. I would roll them down a little bit because you're still probably going to collect premium going out a couple weeks on either one of them. You'll have lower strikes that you won't really need to worry about for right now, and you'll collect some premium against what you had paid initially.
That's interesting because that's kind of what I was thinking is, all right, since I'm short the put that's underwater right now at the 350 that expires next week, or if this thing does find support, maybe I try and be a ninja and, let that then just expire. Maybe it bounces back above 350, expires worthless, then I just stick into my long position, my long put position.
Right.
But then I got to get the timing. I got to hope that the timing just...
It's always a matter of timing. Now, being short that put that expires next week, that is actually huge going into the long weekend. You should see some significant premium decay, but obviously that really is dependent on what the stock does here. So I would look to roll those out, lower strikes, collect some premium, which you should be able to do even if you only go out a couple weeks to like the end of September. And then you've got this 3-month time spread on that is still really flexible for you.
Yeah, I like that because that's what it's about, really. And by the way, I had this paired with kind of the inverted calendar with BTC because I was thinking BTC was likely to be stronger short term, weaker short term, longer. So I kind of had it flipped as a way to play them off of each other. Yeah, exactly. But then MicroStrategy just was starting to soften more significantly than Bitcoin. I got to say, by the way, generally for Bitcoin, held up this week pretty good considering how things started on Monday.
Oh, it sure did. Seeing it here right at 112 or so, after trading all the way down to 108. Absolutely. I think that is a win for the bulls in the crypto market. I know you may have a different thesis on that. I think that's a win for the bulls.
No, for sure. It looked like it could have gotten nasty this week. All right, speaking of which, we closed it out. We were almost at the bell here. And S&Ps are going to end in pretty good shape at all-time highs.
All-time highs, another new record here. And again, just more reason, Oliver, to get some, really, really cheap, inexpensive protection that you hope never comes into play, right? When we go buy insurance, whether it's homeowners insurance, car insurance, whatever it is, you want to buy it when you can and not when you're forced to, when, God forbid, an accident or a catastrophe strikes. So now's the time to do that.
All right. Bell's ringing up day. Got through it. One more with inflation. Thanks, Coach Scott.
You got it, Oliver.
All right. Have a good one, sir. All right. That's it for us. We're at the mark. The bell just rang, and equities had another solid all-time high session. Tomorrow's inflation. I will see you. Maybe I'll do something online tomorrow. I feel like I got to get on to at least see the reaction to the numbers. So stay tuned here on X, YouTube, a little TikTok. I was playing around with the TikTok at the top of the show. Have a great weekend. If I don't see you, back to Tuesday next week, 2 to 3 p.m. Until then, I'll see you online. I'm Oliver Rennick. Thanks for coming to Chicago for the Future of Finance. Hope you enjoyed the show. Until next time.